Well, welcome everyone. This is Heath Phillips. He's going to do a presentation with me interjecting from time to time. My name is Fran Coet. Some of you know who I am. I'm a CPA. There'll be a little bit of an introduction, and Heath is an attorney. So he's the guy that has all the words. He does the training. So, by way of introduction, I do business valuations, and I work with clients that are thinking about selling, thinking about buying. I've been through the due diligence process multiple times with clients, kind of lifting up the hood of the car to see how it operates. And Heath, I know your background, but you want to share with them what it is.
Yeah, absolutely. So I'm Heath Phillips. I'm the managing partner of H.A. Phillips Law, LLC. We are a corporate transactional law firm, so we work with small to mid-sized companies and essentially act as outside general counsel for them. So whatever legal needs come through the door, that's what we take care of. And we do quite a bit of work on the mergers and acquisition side. So hence the presentation. And so we'll be talking about navigating the business purchase process. This presentation came about because the last couple acquisitions that I've gone through with my clients, we've been through the process or gotten a little ways through the process, and my clients started asking me questions about, okay, what's next in the process? How does this all work? What documents can I expect to see? And so I now do the educational piece, basically this presentation with my clients ahead of the acquisition process, and I thought it might be helpful for other people to have access to the information as well.
Absolutely. Well, and we've had clients that have had buyer's regret. We've had because they didn't go through the process as they should have. They didn't retain an attorney. They maybe just dealt with the business broker. They looked online, found a business, and didn't ask right questions. And you have in front of you a Form 8594. And that, as we go through our talk, I will tell you that this is where I feel some attorneys really fail to complete the asset allocation. So we'll get into that.
So without further ado, here's sort of the agenda that we're going to be following. We'll do a little bit of an introduction. We've kind of done that already. I'll give you a little bit of an overview of the business acquisition process. The stages of what I call the different stages of the acquisition, and then just kind of some conclusions and final thoughts to go from there.
Perfect.
So again, Heath Phillips with H.A. Phillips Law. I've been in-house counsel for the past 8 years, 7 years. My own firm for the last 12 months. And I operate mostly in the manufacturing, technology, agriculture, and real estate industries. But I work with any type of businesses.
And I started doing tax returns in 1971, which is kind of embarrassing to say. But in my profession, it's good to have years and years of experience, right? We've been through lots of different tax reforms. We may go through another one, but we're not sure yet. We have a practice here in Westminster that has been around 31 years. In Westminster, we started in 1988 in Westminster. So we've been doing this for a very long time.
Excellent.
Yes, welcome.
So the business acquisition process is somewhat stressful, or can be somewhat stressful. I found this quote from General George Patton that I think kind of sums it up pretty well. Take calculated risks, which is quite different from being rash. So the business acquisition process is a little bit similar, and I like the quote, where you actually are taking a risk in buying a business or selling a business, but with the tips that we're going to present today, it's far from being rash.
Yeah, I've watched Patton many times with my husband, so yes, he was an interesting guy.
So just kind of a general overview. When you think of the business acquisition process, it's somewhat similar to buying a home. You kind of do your due diligence up front in the inspections and title searches and things like that to make sure that the asset you're purchasing is what you think it is and has the value that you want from the transaction. There's different types of business acquisition processes. So the two main ones are the asset purchase and the stock purchase. The difference there is if you're looking at buying a business, you can buy just the assets of the business. So that would be the building, maybe, vehicles, any equipment that they own, customer lists, intellectual property. Those are the assets that are typically purchased in a business acquisition, as opposed to a stock purchase where you're actually buying the shares of the company. And most of the time it's either all or the majority of the shares. So when we talk about asset versus stock purchase, that's the difference. I think this presentation is probably going to be centered a lot around the asset purchase process. And that is generally on the purchaser side. So Fran will talk a little bit about the tax implications, but from the purchaser side of things, the asset purchase is usually the preferable method.
And Heath and I have probably both represented both buyers and sellers. And there's a real simple concept here. What's good for the seller in the transaction is going to be bad for the buyer, and what's good for the buyer is going to be bad for the seller. So from the seller's perspective, if they've got corporate stock, what's the best result that they can get from a tax perspective? To sell the stock, because what is that? A long-term capital asset. So we don't care if there's depreciation to be recaptured or anything else, because they're in a long-term capital gains posture, selling their stock, just as if I sold stock in IBM. What happens then to the buyer? They don't get a stepped-up basis, they're not cherry-picking assets, and they get the business warts and all. So if they're unpaid payroll taxes, sales taxes, something else, and they don't do their due diligence, they're getting a whole ball of wax there. So from the buyer's perspective, they almost always want to do an asset purchase where they can cherry pick the various assets out. But when that happens on the seller side, then they've got depreciation recapture, they've got sale of inventory. Now we've got to go through that asset allocation and figure out how we're going to parse out the sales price. So it's a very different perspective, and that generates a lot of push-pull.
Exactly.
Right.
And from the legal side of things, very similar. So to what Fran just referred to, in an asset purchase, the buyer is actually relieving itself of any future liability. In a stock purchase, most of the time that liability comes along with the stock. So if there's any future claims or suits, then the buyer is going to be vulnerable to those sorts of things. Right. One of the very crucial things, and we're going to touch on this a little more in the presentation, assembling your team is crucial. And what I tell my clients is it's best to get your team assembled ahead of the transaction. So if you're even thinking about buying a business or looking to make that purchase, get your team interviewed and assembled ahead of that so that they can be involved in all assets or all aspects of the transaction. And when I say your team, I'm talking about a CPA who preferably would be also a valuation specialist, just like Fran and her team, an attorney, and then a business broker. So we'll talk a little bit more about the business brokers. Okay. And Fran, maybe you have some experience there.
A bit.
But yeah. There's good and bad with right. The business brokers. They can be very helpful, though.
And there again, it depends upon the buyer or the seller.
Exactly.
And, yeah, exactly. Bear in mind who they're representing.
Right.
Right.
Okay, so stage one in the actual acquisition process. So stage one is what I like to call the analysis. And the considerations here are the purchaser is going to have to take a look at what kind of business they're looking for. So they're going to take into account what their budget is, what they want to pay for this business, how much money they have to make that purchase, how the financing is going to take place. Are they going to go with a bank to get a business loan for this acquisition? Is the seller actually going to carry a note? So that's another financing method that might be a possibility.
And there's no one size fits all. The buyer may have 10% down or may have 20% down. If it's SBA, historically, they want the owner to do some carry because they want the owner to continue to be involved for a period of time. So it just depends upon facts and circumstances, how the financing works in a business buy or sell.
And then what I tell my clients too is take into account your capabilities and experience. So if your background is in technology, maybe an agriculture or an accounting business probably isn't a great fit for your capabilities and experience. On the other hand, I've talked to folks who have been extremely successful in any business. They're just business type people, and so they really don't care. But it's probably best if you have some sort of experience or capability in the business that you're looking to purchase.
And it's best not to go to a trade show. We had a client that went over to the Denver Merchandise Mart, and there was a trade show with franchises. You know, a $10,000 franchise sounds really cheap until you involve yourself in a 7-year lease for a pizza place when you have no background in making pizzas other than maybe for your family. That becomes a very expensive $10,000 buy-in. We had a client that had exactly that profile. It was a very inexpensive franchise, and after 3 years, the franchise in essence disappeared, but they were still on the hook for the remainder of the lease. Just wasn't a good fit all the way around, and it was a very dangerous, cheap buy. So.
And I've actually seen agreements in that franchise space where the term of the agreement is 10 or 15 years. So 2 or 3 years into it, they realize that it's not a great fit, and they're still on the hook for the remaining term.
Yeah.
So.
Bad.
The other thing to take into consideration is the operation of the business. So after the transaction closes, how are the operations going to work? Are you, as the purchaser, going to actually take part in these operations, perform some of the duties, or are you going to hire new people to do that for you? So it's best to consider that on the front end.
Yeah.
Also in the analysis, so some of the information that you're going to want from the seller at this portion of the transaction, market information. So where is this business in the marketplace? How do they compete with their competitors? How do they differentiate their goods or services in the marketplace? So, and that's all going to go toward the valuation of the business. How valuable is the business as a going concern, and what sort of benefit are you going to get as the purchaser when the transaction closes?
I had a client up in Broomfield many years ago, because I've been doing this for a long time, and they were a bookkeeping client. They owned a flower shop. They had purchased the flower shop, had it for about 3 years. It lost money every year. Flower shops are like bike shops. You have to really love that particular industry because you're going to lose money. Almost inevitably, you're going to lose money. So they asked me to do a business valuation because they decided they needed to get out after that period of time. I did, and I said, basically, it's worth the fixed assets. And I can't remember what number I gave them, 10,000, whatever it was. And they said, well, that can't be possible because we paid $17,500 for this 3 years ago. Why did you pay $17,500 for it? Because it's what he was asking. Okay, I wanted to find them when I had a used car to sell. Just because it was the ask price didn't have anything to do with the value proposition. So I can put a sticker or I can put a sign in the window of my '86 Toyota Corolla and say I want $10,000, but the market isn't really there. It was a very bad buy for them, and they ended up just closing the store because they didn't believe it was only worth the van and the fixed assets.
Absolutely.
So, and look at the history of the business too. I like, if I possibly can, when I'm looking at financials, to get back into 9 and 10 and 11, even though that's beyond a 5-year look back, just to see how the business survived. And it might have been butt ugly in my grandson's terminology, but did they make it through that great recession that we had, and how did they do that? Did they have to leverage? Did they take advantage of the marketplace? What was it? The history of the business is really, really important.
Absolutely.
Right.
And what I like to look at from the history side as well is, has the business pivoted in any way? So it may be that the business is 20 years old, but in the last 3, 4, 5 years, they're doing a different type of business than they were in the beginning. So all of these are considerations and have a big impact on the value of the business moving forward.
Right.
So in the stage 1 analysis portion, after you get all of this information and you have your team look it over, then it's kind of a go, no-go thing, right? You decide whether you're going to move forward, get more information. It has a potential value, and so You use that information to decide if you want to move forward.
And this is a juncture to walk, because you don't have anything really invested
Right.
in it. Maybe some fees because of the attorney and the accountant, but if it doesn't feel right, if it doesn't feel like a good, the best advice I can give you is don't go any further. The best deal may be the deal that doesn't get made.
Exactly.
If that makes sense. If something doesn't feel right, if you ignore signals because you're so determined to buy a business or so determined to sell, you just have no idea what kind of heartache that can lead to. So,
Exactly.
okay.
So stage 2 is what I call the preliminary due diligence. So this is where you really get your team involved. The team members mostly are the CPA or the valuation specialist at this point,
Right.
because this is the stage where you want to land on the valuation number. And so somebody like Fran and her team are completely invaluable. I'll tell you a little story. One of the acquisitions that I've completed in the last year, the seller of the business had this business valued at between $750,000 and $800,000. My client, who was the one acquiring the business or looking to acquire the business, came to me for advice. My first piece of advice was get a CPA, get a valuation specialist involved. So there was a significant amount of time on that front end. They probably spent, I'm guessing, between $20,000 and $30,000 in fees from the CPA firm, because it was a very in-depth analysis and valuation.
At this juncture?
At this juncture.
Wow.
But I can tell you what ended up happening is they settled on a sale price of $550,000. So there was at least $200,000 and probably a little bit more, $200,000 of savings there, just by getting that team member involved early in the transaction.
And I do business valuations. I belong to the National Association of Certified Valuation Analysts, and one of the things we do to recertify every 3 years is we look at a business valuator's report. Somebody submits it, and then we have a table discussion for a couple of hours after we've read through the report. It's pretty astonishing what can be out there. A business valuator may skew numbers, may make assumptions that aren't well disclosed, and so just because it's got a CPA stamp on it, and they may have followed the right protocols, but if you can't make the numbers work for you, that's kind of the due diligence process. It's not redoing the valuation. It's looking at the hypotheticals and scrubbing numbers and trying then to forecast, well, if you're looking for a job of $300,000 a year and there's only cash flow of $2, this isn't for you. You know, that's
Right.
kind of straightforward, but yeah. Or the assumptions that they're making just are pie in the sky, not
Right.
going to happen. We're going to grow by 50% in 2 years. That may be a little far-fetched.
Absolutely.
Right.
And as you probably all know, is in the area of small business owners, they're personally invested in these business, and so their idea of the value of this business is usually a lot higher than what a valuation specialist is going to come back with.
And a lot of times it's what they need. It's the way an individual prices their house. Well, I've got to have $200,000 down to buy what I want to buy and pay off my debt, so my price is going to be, the mortgage is $500,000, I need $200,000 for the next 5, the price must be $700,000. When the market may say it's $550,000. You just, and a lot of times the business owner may have ignored their own retirement needs, which is what I see a lot of, because their retirement is their business. So they figure, well, I need $50,000 a year to retire on. I got to sell this for $1 million because I've got to make that kind of money. That, again, is not going to be good for the buyer.
Right.
If you just take their word for it.
Right. So the documents that you're likely to see in this preliminary due diligence stage are a non-disclosure agreement and a letter of intent. So the non-disclosure agreement, obviously everybody probably knows what that is. I usually recommend a unilateral non-disclosure agreement, which is an agreement that goes both ways. The buyer may be providing information to the seller about their financial stability. The seller is going to be providing information to the buyer about their business. And so both of these parties have a vested interest in keeping that information confidential.
And sometimes, Heath, I've seen attorneys kind of bypass the letter of intent and go straight to the asset purchase document as kind of a working document. So if you think about buying a house, you do a purchase contract through a realtor, right? And you say, based upon these conditions, I'll buy your house March 1st of next year for $550,000. But then the contract goes on for 2 or 3 pages and it says, well, subject to soil samples and subject to the HVAC working and subject to, so there are all kinds of conditions that are going to be prior to that closing happening. And the same thing is true here, that the value is going to be supported, that there aren't any unpaid taxes, that there, whatever it is to protect both sides.
Yeah.
Right.
And I've seen it both ways.
Yeah.
So in certain transactions, the buyer and sellers have extensive conversations and negotiations ahead of the transaction, or any of the getting the attorney or the CPA involved.
Right.
In situations like that, I've seen where there is no letter of intent or term sheet,
Yeah.
and the transaction goes very smoothly. I've also seen most of the time there is a letter of intent
Almost
because,
always. Right.
like Fran says, you want to get the key terms sort of locked in prior to the negotiations. And although the letter of intent is not necessarily, in most cases, a legally binding document, it's hard from a psychological standpoint for either party to vary from those terms once they're agreed upon.
Right. Okay.
So also in the stage 2 preliminary due diligence, the financial due diligence, obviously, in my opinion, is the key at this stage. And so I'll let Fran take it.
Well, and this is a short term, I would say this is a minimum structure, but I think in your stage 3, you go into more depth. So this is kind of the first blush. The brokers put a price on this, or the sellers put a price on this. Now we want to get down under the hood and we want to figure out what really makes this business work. So the fact that revenues have grown for 20% a year for the last 3 years may be insignificant if the bottom line is that they're losing money. And a lot of times a broker will put together a marketing brochure, and that's exactly what they focus on. Revenues were $1 million, $1.3 million, $1.6 million over the last 3 years. Well, gee whiz, but if you're hemorrhaging losses, it doesn't really matter anyway. And you want not only financial statements, but tax returns. Why? Because we're going to test those once against the other. Kathy Asmus, who some of you know, worked with me on a business valuation I just had. It was a divorce case, but it's the same concept. And the tax returns over 6 years and the financial statements that were in QuickBooks were like this. It cost us about $3,000, the client about $3,000, to make the tax returns even close to what the financial, he changed accountants every other year over the 6-year period. And they didn't pick up carryovers. It was just kind of astonishing. I am not qualified to figure out what estimated values are of fixed assets. So the business owner may have taken very aggressive depreciation, written everything off to zero, because they can. You have to have an idea of what that is. And usually the best place, if it's manufacturing, is to go to the vendor who provides it, because they market in, for example, Scott probably in printing. You would go to the vendor who provided the printing presses and the software to get an idea of what market value is for the used equipment. It doesn't have to cost a lot of money, but you at least want an idea of what that's going to look like. Top 10 client lists over what period of time? How have you billed? What are the accounts receivable like? How do you turn your receivables? What are your billing practices? Are you sitting on a bunch of deposits for customers? I had a client years ago, a baker, who did wedding cakes, and he would take reservations a year in advance of the weddings, and in order to book that time, he was taking 50% of the sale price of that wedding cake into cash here, and he didn't have good records to try to figure out what bride X was going to want a year from now, but he got half of the cash. Well, that was going to be a liability of the purchaser if they stepped in and bought the business, and the cash was already in the pocket of the seller. Well, you've got to understand that you're buying a liability there and a commitment. So the list of debt may not be comprehensive. just did a valuation where they had negative receivables. Well, that's because they're taking deposits from their customers. That's another example of like, well, that's not a negative receivable, that's an unearned liability. We got a problem there. Who are the employees? This is all kind of done in a shroud of secrecy because we want the employees to stay in place. Sherry's got a lot of knowledge about the client she works with. Christina's got a lot of knowledge. We want those employees not to be disturbed. We want to know how long they've been with you, what their roles are, what their pay is, and we also want to know if we're a business owner who's buying another business, can we get rid of some employees on either side because we've got duplication. So all of that. And then bank account information. What are we going to test? We're going to test the bank deposits against the financial statements, against the tax returns. All of that, you want as many verification sources as you possibly can get. Just because the broker said, well, their sales are $1 million, $1.3 million, $1.6 million, means nothing without being able to prove it. Right?
Yep.
Okay.
So from the...
You are.
We'll take questions at the very end. Thank you. So from the legal due diligence side, what I'm going to be looking at, the main things that I'm going to be looking at, the business entity formation. So are they registered with the state? Is it the same name of the business that's registered with the state? Are there corporate documents in line with what's registered? A cap table. Who are the owners of the business? So from a stock purchase standpoint, this becomes extremely important. Even from an asset purchase side, though, you want to know who you're buying the business from. And so whether these are individuals, whether they're corporations, LLCs that are owners of the business, you need that cap table to go over that. And then any list of partners, joint ventures, any kind of partnership arrangements, subsidiaries, these are the things that I'm also going to be looking for from the legal due diligence side. And this, again, has a huge impact on the valuation of the business, the operation of the business post-closing, and so you're going to want to get all of this information up front. And then, you know, this is a little touchy, but I put this in there just because some clients really like it, other clients not so much. But after we get the cap table, if there's individuals listed on the cap table, it's a possibility that you might want to do some background checks. So we can do a background check to see if there's any pending litigation, any past litigation. Bankruptcies are sort of a big deal, right? If these people are owners of a business, they're selling the business, and they declare bankruptcy 2 or 3 years ago, it might be a little red flag to do a little more investigation.
Right.
And maybe a criminal history or a criminal background check as well. So there's always, you know, I say this at the conclusion of the presentation, no matter how good the documents are, no matter how good your due diligence is, there's always going to be an element of trust in these types of transactions. And so you have to get yourself to a point where you trust that the information you have is good and that what the seller is telling you or what the buyer is telling you is actually true. And
I love that we had a client that was looking to buy a liquor store up in Longmont that had a drive-through window. Okay. I don't know, you got your 40s quickly or something. Anyway, this was years ago when Rocky Flats was closing down, and the seller said, well, I've got $100,000 a year that's not hitting the tax returns, not hitting the books. And the buyer said, well, how do I prove that? I said, well, you're going to go sit there, and you're going to watch what happens, and you're going to compare it. So he did buy the liquor store, but he wanted me to sign off with the SBA that there was an additional $100,000. Well, indirectly, I could kind of get there by cost of goods sold, because when you look at ratio analysis and what typical costs for liquor stores were, it was a good guess that he probably was skimming that much money. He turned off the register on the drive-up window Friday at 5 and didn't turn it back on again until Monday morning. Okay, and that was half of his sales over the weekend. When do people drink? On the weekends, right? So all I could say was indirectly, if I looked at industry standards for the gross profit margin, there was that much that was probably not on the table, but could I prove it? I'd have to sit there and go through it. Yeah. So background checks are pretty important, especially when the seller tells you they've been cheating IRS, they've been cheating. And my problem is, why should they get it again?
Yep.
That's the other problem I have. If they've been living for 16 years with this business and skimming that kind of cash, now they expect the buyer to pay them for it on their word. That's a form of a background.
Right, right.
Okay, yeah.
Yep. And from a stock purchase standpoint, that can also open you up to liabilities later on, so pretty important. So stage 3 is what I call the in-depth due diligence. So assuming that stage 2 goes well, your valuation specialist comes back with a number that you really like, the seller agrees on that number, then we go into what I call in-depth due diligence and negotiation. So going back to what Fran said, this is where the attorneys usually get involved. We start off with the asset purchase agreement or the stock purchase agreement, and we start hashing out all of the individual terms of that agreement. So as Fran said, in my experience, those are usually living documents. They go back and forth several different times with several iterations, always relating back to that letter of intent or term sheet. So, and I'll touch on this at the conclusion as well. But the stock or asset purchase agreement is the primary document in the whole transaction.
Right, makes sense.
And then the team members at this stage, every team member is involved in the
Right.
transaction.
Right. Looking at whether the valuation still tests out.
Exactly.
Whether anything, the sales are starting to dip, and why is that kind of thing. And I think even in the best deal you could possibly have, things can go wrong. Because you offer warranties, because there are customers that are going to bounce back. Who's going to cover that? If I did the work and I sell the business and I've got a year's warranty on a product, is there going to be a chargeback? Is there going to be a reconciliation? How am I going to figure that out? That makes these documents very lengthy. And you can miss stuff. I mean, if you don't do the deep dive, you really can miss a lot of
Absolutely,
transactions.
absolutely. Even on a really moderate type of acquisition, the $500,000 deal that I was talking about earlier, I think our asset purchase agreement was still 55, 60 pages long with all the disclosure schedules. So it's a very in-depth
Oh, you've
document.
got environmental concerns, and you've got
Exactly.
just all kind. I had a client come to us years ago wanting to buy a business, and he said, "Well, this is harder than buying a house." Okay, well, number one, the business is going to pay for the house, so I think it requires a lot more due diligence because you're looking for this to make a living out of. The house is just shelter. Right? Isn't that the whole idea? So you really do have to spend a lot of time. And now he's getting more to my timeline. I like to look at 5 to 7 years worth of financial statements, of tax returns, same kind of tests that I talked about earlier, the client list. And as a business owner, this is really scary. It's very concerning to kind of open up the trench coat and show all of the warts and all of the problems that there are. But the buyer needs transparency. They need to know, is this customer a problem? Is this somebody that may come back, or they're thinking about going someplace else? You need to really get down into that list. If there's real property involved, then of course the attorney's got to check for title, got to check for any leases, any encumbrances at all. And the same is true with the UCC filing with
Absolutely.
fixed assets.
Yep,
Right.
encumbrances on assets.
Right.
Yep, and from a customer standpoint, you'll notice that the difference between stage 2 and stage 3, we had maybe the top 5, top 10 customer list in the initial due diligence. When we're in the in-depth due diligence and negotiation stage, we're going to need a complete customer list. And one of the considerations there that I tell my clients is that you want to be cognizant of the possibility of some of these customers leaving. And depending on what kind of business it is, especially if it's a service type business, the owner may be a key person in some of the relationships with the clients. Some of these customers may leave, and you want to keep that in mind.
Exactly. more financials, the payroll taxes, verifying. If they're using a PEO, they're using a payroll service, generally you can rely upon the fact that the taxes have been paid. Heath, here in Colorado, don't we have a bulk transfer problem anyway? If I cherry pick assets out of a business to buy, but they haven't paid their sales tax, could I not have responsibility for the sales taxes?
Absolutely.
Right.
So you're going to
The
have
bulk
liens that
transfer-
follow the assets.
Right.
So even if you are doing an asset purchase, you may end up with, as the purchaser, you may end up owing these taxes, these back taxes, to get rid of any liens.
And payroll involves a lot, including I-9s to make sure that the employees are eligible to be working here in the U.S. It kind of drills into what their practices are. Are they treating everybody as an independent contractor? Should they be treating everybody as an independent contractor? Do they have their workers' comp in place? Do they have liability coverage? And there again, who's their carrier?
Right.
The attorney's going to probably want to know and contact to see if there are any pending claims, right?
Exactly.
Employee benefit plans. Employees are the most valuable asset of any business, period, as far as I can tell. I certainly appreciate mine. And if the seller has already got in place a health insurance program, a 401k, if the buyer intends to strip those benefits out, that could be a very costly decision. So in forecasting, they need to bring in whatever there is, or they might add something that wasn't there to begin with. And again, back to the bank statements again, because now we're digging deeper. How many of us have paper bank statements for 5 years? Probably not. How long do the banks keep their records, Kurt?
7 years or more.
7 years, but what's the cost to get at 2 years plus? It depends, okay. And how friendly the banker is, that's right. Because what's online is maybe 9 months, 12 months worth. Yeah, if you haven't downloaded PDFs of your bank statements and you're going to sell, that can be a problem. And if I want to reach back to see what happened on the 5-year-old tax return and compare it to the bank statements, that can be expensive pretty quickly. Promissory notes, of course, we're going to test the liability against the mortgages, against promissory notes, and the UCC filings.
Exactly.
Right.
So from the legal standpoint, we're going back to the corporate documents again. So not only am I looking now with the Secretary of State to make sure that the documents are in place, that it matches the name that the prospective buyer is giving me. Now I want to see the actual shareholder or operating agreement, whether it's a corporation or an LLC. What are the terms in that agreement as it pertains to stock transfer, if it's a stock purchase? Any limitations on transferring assets? Which one of the owners or managers has to sign off on the whole transaction? So those are the types of things that I'm looking for when I'm looking at the shareholder or operating agreement. Meeting minutes. So a lot of companies don't actually keep meeting minutes. Their founding documents usually say they're supposed to, but it varies as to whether that's actually happening. But what I'm looking for there is, because usually the meeting minutes document significant transactions in the lifetime of the business. So I'm looking for new shareholders or partners that have departed. Do they still own their shares in the company, or did they get bought out somehow? Those types of things, or amendments to the operating agreement. So maybe the operating agreement has certain limitations on asset or stock transfer, but if it's been amended at some point down the line, then that should be documented, and we want to find evidence of those changes. And then again, from a standpoint of any partnerships, subsidiaries, joint venture arrangements, we want copies of those agreements. And then securities documents. So this is especially crucial if it's a stock purchase, because you're buying the actual stock of the company. Not necessarily as crucial on the asset side, but you're going to want to know, are there any certificates out there, warrants or options hanging out there that somebody could have ownership positions in the company? And usually the operating agreements or shareholder agreements are written in such a way that the liquidation event that is taking place with this particular transaction usually triggers some of these warrants or options. So you're going to want to take a really hard look at these documents.
Employment contracts?
That's coming up.
Okay,
Yep,
that is.
absolutely.
I'm a great straight man, right? Okay,
So from
There it is.
finance side,
Right.
this borders on the financial side of things as well.
Right.
Obviously, your team is working together on the transaction and the due diligence in this stage, but I'm looking at any buy-sell agreements. So usually there's some buy-sell provisions in the operating or shareholder agreement. If there's not, are there separate buy-sell agreements that limit the way the stock can be transferred or assets can be transferred? Any promissory notes, and specifically promissory notes to shareholders or partners. We're going to want to make sure we have copies of those. And then the convertible debt documents, I touched on that earlier. Bank line of credit agreements. So this is especially crucial, and even in an asset purchase transaction, these line of credit agreements are really, really crucial. Because typically what happens, the bank gives the business a line of credit to operate their business, but the collateral is either inventory, accounts receivable, or any assets that the business has anywhere in the world. And so these line of credit agreements usually are fairly airtight from a collateral standpoint. And if you don't have those, then even in an asset purchase transaction, you could end up with some liability on the tail end.
and if you're the buyer, you could be in the catbird seat if the bank transactions don't get transferred appropriately or killed off. We had a client that sold a business, and the line of credit was still active to the business. It was a stock sale, and he had co-signed the line of credit.
Right?
That was neglected when he sold the business to a cousin. It was a family member, and they ran up the line of credit and bankrupted the business, and our client was left on the hook with the line of credit. So really critical. These have got to be refreshed and requalified, and all. You agree, Kurt, the banker who's in the room? Yes, really critical, but that
Absolutely.
was just devastating, and our client ended up committing suicide over it.
Oh.
It was not well. It was a really bad situation. He was just crushed that the family member had done that, and they're really legally the bank wanted their cash.
Right. Right.
It was just a bad situation all the way around.
Yep.
Yep.
So we're looking also on the operations side of things. So this is where we're looking for any supplier or vendor contracts. If you're a manufacturing company, then they usually have these manufacturer, raw material, supplier, toll manufacturing agreements in place. And so you're going to want to get copies of all of these. The key thing here is I'm looking for assumability. So one, does the purchaser want to keep these agreements in place post-closing? Two, can they keep them in place? Or three, are they bound after the transaction
keep them in place.
Right, they don't have a choice. They're
Right.
gonna remain in place. And the other thing that we're looking at are the terms of these agreements. So, for example, if I'm buying a manufacturing business, they have a raw material supplier for the key ingredient in their manufacturing process, and they're tied into a long-term deal that transfers with the business. Then you're going to want to decide, do I want to be locked down with this agreement? Do I want to assume the agreement, and what's it going to cost me to get out of that type of agreement?
Exactly.
Also on the operating side, company processes and policies. So if you have a manufacturing company or a company that makes products or even service-based businesses, the most robust businesses have these processes and specifications in place already. You're going to want to make sure that they're written down, company policies and procedures as well. The other thing you're going to want to make sure is that they're actually being followed, because that's a really good indicator of the viability of the business after you purchase it and the existing owner exits the picture. So,
Yeah, think about buying your favorite Italian restaurant that you've been going to for 20 years, and they decide that they're going to sell that. Wouldn't it be nice if you had the recipes? Right. Well, it's the
Exactly.
way Mom made it. Okay, well, I can't replicate what Mom did, so you're going to have to get some due diligence in there, and they're going to have to spend some money trying to recreate those recipes. And,
absolutely.
right, and document it. And the same with the processes. What's the sous chef doing? What's the prep person doing? Just so everybody knows what they're supposed to be doing. That is a manufacturing
Right,
environment.
right.
It's just a little different.
Exactly right.
Pretty quick turn on inventory.
Yep.
But yeah, all of that.
So sales and marketing documents. So maybe you have, from a legal standpoint, what I do for my clients is I draft on the service side of things what I call a master services agreement that they can use with all of their clients. For companies that sell products, they usually have a product sales agreement that they have their customers signed. And if they don't, they should. But what I'm looking for here in these agreements, one, are they in place? Two, are all of the customers signing these agreements? And three, are the terms of these agreements standard across the entire client base, or are there exceptions with each individual transaction? And so we're scrutinizing all of these documents, and it's especially cumbersome if maybe you have a company that has 500 customers and they do custom agreements for every single customer. So
Or it was a Bob deal.
or
it
a
was
verbal
John deal.
agreement, yeah.
Well, yeah, we have to talk to Ken about the
Yep.
pricing because he's
Right.
the only one that knows. We had a client like that. They couldn't price any of their products because Ken was the only one that could do it. And Ken went on vacation. It virtually shut him down. You better know that if you're buying a business.
Exactly,
Right.
exactly. So are there any license agreements? So in companies that have significant intellectual property, patents, trademarks, copyrights, are any of those rights licensed to any other entities? If so, for how long and under what terms? So the viability of the business moving on post-closing is going to be dependent on those types of agreements. And then any consulting agreements, warranties, guarantees. Fran already touched on this. If there's warranties or guarantees, those are outstanding liabilities that could come back on the purchaser, especially in a stock purchase type situation.
And how frequently are you going to try to adjust that? Are you going to sit down once a month? Are you going to sit down at the end of the quarter? There could be chargebacks going back and forth long after the contract was entered into. So
Exactly.
it can be very dangerous.
So here's the employment
there
side
it
of
is.
things, right? So
I knew you were going to get there.
Exactly. So from the employment side of things, also very important, one of the key things that we look for is an org chart. So
Yeah.
who are the key employees, who are the employees that they manage, and all the way up from upper management, all the way down to, if it's a manufacturing facility, to the floor. The other thing that I'm looking for here is what are the relationships to the customers? So who are the key people with the customer relationships? Because especially in a services-based business, that's going to be the key metric of the viability of the business moving on. If your key customers are having a relationship with one of your salespeople, and that salesperson decides to go once this acquisition takes place, then the value of the business looks very different than it did on the front end.
And some employment agreements can be contractual, binds to the buyer if there's a certain benchmark that's built in, a salesperson, if sales hit 5 million, then there's a bump or a 5% bonus
Absolutely.
to the employee. You've got to know what that's going to look like before you buy into it.
Absolutely. And this is especially crucial also in situations where you have maybe sales employees who get commissioned. So what are the terms of that commission agreement, right? Is it they get paid for 12 months past when the transaction takes place? It could impact the buyer of the business as well.
What about sick pay policies? What about vacation pay? A lot of times those are unrecorded liabilities. Businesses just don't keep track of that, but they've got a 2-week sick pay or they've got a 2-week vacation pay. And if that isn't sitting on the books as a liability payable and you step in, you may be responsible if you sever the relationship or they decide to quit.
Absolutely.
That can suck all kinds of cash flow out of the business very rapidly.
Absolutely. I just helped a client close on a transaction where one of the employees was a relative of the owner of the business, and she had 50-some weeks of vacation racked up.
Oh.
So she never took
Where did she
vacation.
work?
Yeah, exactly. Now, fortunately, we went through.
That's better than government.
Yeah,
Yes.
exactly. We went through
Wow.
an asset purchase, so the purchaser didn't necessarily have to assume that liability. But certainly, it's a big red flag when that comes up,
man.
and so that's why we need copies of these things. And then, of course, the employee handbook. So this is how the company treats their employees, the policies that they have in place moving forward. If it's an asset purchase, you're not necessarily on the hook from a liability standpoint. But again, a lot of this is psychological. So you don't want to walk into a business look at the employee handbook and then immediately change everything or the way the business operates as it relates to the employees, because then you're going to have a lot of employee turnover.
And some small businesses just don't do a good job of having this kind of documentation. So if it's a seller that's thinking about selling, this is just a reminder to what you may not have on hand right now that you probably need to work on.
Yep,
Right.
that's a great point.
Yes.
Yep, if you are a business owner and it's in the future that you're looking at a possible acquisition or selling the business as your liquidation event or retirement plan, making sure these things are in place is a really good idea ahead of the transaction or ahead of any negotiations.
And how far ahead? A couple of years maybe?
At
Yeah,
least.
probably.
At
Yeah.
least, yep.
Okay.
So the management team, right? We have the organizational chart, so we know who the key players are from a management standpoint. We want to know if there are any agreements in place with these management folks. So typically these folks are the most highly compensated. They're most likely to have employment agreements in place with severance terms. So how much are they going to get paid on any liquidation event? And then from a stock purchase standpoint, it becomes a little more crucial. Are there questionnaires in place? So if any partners or shareholders bought into the business, was it done correctly? And are there any SEC questions lingering out there from a stock aspect?
And I would suspect that that's more getting into a much larger company where they could be launching to do an IPO or
Usually it is, yep.
And then you get into blackout dates and all
Right,
kinds of
right, exactly.
of bells and whistles that
Yep.
most small businesses don't
Right.
have.
And I
to
actually
worry
haven't been involved in any acquisitions where this has been a huge concern. I have heard of and read of transactions where it becomes a concern, even on a small business side, because business owners can be a little bit ambitious when it comes to selling shares in their company and looking for investors.
Right.
And if they go about it the wrong way without proper legal counsel, they can get themselves into trouble.
Understood, yeah. Absolutely something to look for.
Yep. And then from a management standpoint, non-compete and non-solicit terms are going to be key in this transaction moving forward. So if you have key managers, owners of the business that maybe own relationships with key suppliers or customers, you're going to want to make sure to have non-compete, non-solicit terms, either in the purchase agreement or in separate agreements
Right.
post-closing.
Okay.
Intellectual property. So
There are
this
the
is-
recipes.
Yeah.
Yes, where are they?
Exactly.
Yes.
So copyright, patent, and trademark are the main intellectual property that we normally think of, but even registered and unregistered. So you can have a
Absolutely.
patent registered with the U.S. Patent Office. Obviously, that's a piece of intellectual property. The classic example of unregistered intellectual property is the recipe for Coca-Cola. They've never patented it, and all they do is keep it really secret. That's an asset that the company has, probably the most valuable asset that company has. But you'll also want to make sure that you specify when you're talking about intellectual property. It doesn't necessarily have to be registered to be protected. And then anything pertaining to website, domain names, brand names, product names, trade secrets, which is the Coca-Cola aspect.
Sure.
Any DBAs that are registered with the state. So that's a form of registration for a service mark or a trademark, but it could be on the state level or the federal level.
In the due diligence process, cybersecurity becoming an issue?
Absolutely.
I don't know if you've got a slide here or not, but
I
that
don't,
would be,
no.
to me, a big deal. And it's interesting that you don't have telephone numbers.
Good point.
Because that would be a good thing to purchase too. In the case of a pizza parlor, for
Right,
example, that
right.
does a lot of delivery, that phone number is a very big deal because
Absolutely.
you want to be able to make sure you can transfer that, you
Yep.
can buy that.
Yep.
Okay.
So other things to keep in mind in this in-depth due diligence negotiation, stage 3, audits or litigation. So has the IRS come in and done an audit, or is there a pending audit? Is there basically a letter notification that there could be an audit? Fran obviously is used to dealing with those. Similarly on the litigation side. So the way we normally word it in the purchase agreement is current, pending, or threatened. And even a letter from a customer, supplier, ex-employee, even a letter saying hey, we have a dispute here, and if we don't get it resolved, it could result in litigation. You're going to want to know all of that, and especially in a stock purchase standpoint. From an asset purchase, not necessarily as crucial, but it still impacts the valuation of the business.
Well, and again, I am just determined that there's bulk transfer issues in the state of Colorado where if it's the priority, it's the
Sure.
IRS, it's the Colorado Department of Revenue that's going to be an issue, even if you cherry pick assets out of a
Right,
business.
right, right.
There are certain liabilities that will follow even if you don't buy the stock.
Absolutely.
You can still have problems.
Yep, from an asset encumbrance standpoint. Yep, no question. And then any government filings. So again, more crucial on the stock purchase side of things, but you're going to want to look at SEC filings, any state blue sky filings in the sale or purchase of these stocks prior to your transaction.
Trademark.
And then any other material or significant contractual obligations. You're going to want to know about that as well.
Sure.
So, stage 4, everything has gone well. The negotiation of the purchase agreement has progressed. The parties have at least verbally, or the attorneys have reached what they think is a consensus on the purchase agreement, and that's usually when we go to the closing. So, and from a timing standpoint, I didn't put this on any of the slides. Timing can vary drastically. So what I've seen on the front end, stage 1, stage 2, anywhere from a couple of weeks to 2 to 3 months, depending on how deep the buyer wants to go in the information that they're asking for, depending on how much information the seller wants to provide. Like Fran mentioned, even if you have a non-disclosure agreement in place, sometimes the buyer is really reluctant to turn over certain types of information ahead of any significant agreement or getting the terms worked out.
And you can have even a deferred possession. We had a client that bought a little copier company and pack and ship type of thing, and they closed in October. But the seller retained the business through the end of the year because Christmas, that month of December, they generate 40% of their sales. Well, the seller was not going to sell that revenue, so the buyer could not take possession until January 15th. When you have a deal like that, you better have working capital when you step in because the seller has taken all of that working capital, cash flow, out of the business, what would normally be available to kind of cover lean months in January, February, and March. So you have to kind of buffer your sales price by letting them keep a big sale contract or something like that. Do you buy the receivables that belong to the business? That's a question. You don't have to. Some people do, some people don't, but usually if it's beyond 90 days, don't want to touch it. If they couldn't collect it, why,
Right.
why am I going to be able to? And if you do not buy the receivables, then you've got a buffer for working capital again because they're taking that cash flow out of the business if you're saying, you keep your receivables and I'll just start fresh. Just all kinds of different ways to have that happen.
Yep.
And all kinds of agreements that have to be made inside this.
Exactly. So the final documents that you're probably going to see in this type of business acquisition process, obviously you have the big one, the asset or stock purchase agreement, which all of the things that we have gone through in the stage 3 in-depth due diligence, all of those things that you ask for from the seller or that the buyer asks for from the seller are going to be included, and we talked about this already. The length of the document gets pretty extensive because all of these things are included in disclosure schedules in the actual purchase agreement. So some of the other documents on an asset purchase, you're going to look at a bill of sale for the assets that are being transferred. For a stock purchase, you're going to look for subscription agreements. So anybody who's getting or buying stock, they're going to have to sign these subscription agreements, and essentially what the subscription agreements say is they agree to abide by the terms involved in the operating or shareholder agreement associated with the stock that they're purchasing. And then you have assignment and assumption agreements. So there can be 2 or 3 of these depending on the assets or the stocks that are being transferred. The 2 that I see most often are just kind of an overarching general assignment and assumption agreement. and the intellectual property assignment and assumption agreement. So the seller is assigning and the buyer is assuming these contracts or contractual obligations.
And then the financing documents, of course.
There you go.
Yes. So, and the line of credit that has to be
Yep.
refreshed, and the security agreement, the UCC filings
Yep.
have to be signed off on. And if there's a carryback, where the owner is going to carry back part or all of the purchase agreement, then there are more promissory notes in addition to whatever bank loans, et cetera, there may be.
Right. And typically what I see in the financing documents is if there is a seller financing aspect to the transaction, the seller's going to want to collateralize that promissory note with assets of the business. If the assets of the business aren't adequate to completely cover the promissory note, that's where they're going to ask the buyer for a personal guarantee.
Right.
And so that's where those normally come in. And again, the non-compete, non-solicit agreement. So not only for the upper management team in the company, key for the seller. The seller, and especially in a small business context, the seller probably has key relationships with vendors and customers. You're going to want to get them tied up with a non-compete, non-solicit agreement. So now what I hear most often on this aspect is people say, well, in the state of Colorado, non-competes aren't necessarily enforceable. To a certain extent, that's true. There's a lot more leeway in the purchase of a business context than there is with just a general employer-employee relationship. So where a certain type of non-compete may not be enforceable from a company to an employee, it might be enforceable from a buyer to a seller.
One of my favorite stories, my husband grew up in Evanston, Illinois, and Skokie, which is a neighboring suburb, had a place called Big Herm's. Sausage, of course, deep fat fried. That's what they sold. Sold the business, crossed the parking lot, there's a building going up. What's that going to be? Well, it's Big Herm's East. They sold, got the cash, and built a brand new restaurant right opposite, because they owned the land, of the same parking lot in which they had operated, and set up Big Herm's East. So having a non-compete as part of the agreement is, and there was none in the sale.
Wow.
Yeah. And they still coexist to this day. That was probably 40, 45 years ago.
Wow, wow. So one of the key documents that we didn't touch on, Fran touched on earlier, but one of the key documents is this 8594.
Yes.
And with
Yes.
asset allocation.
Right there. Yes, my
or
favorite.
purchase price allocation.
Yes. So if it's an asset purchase, IRS is not in the business of trying to negotiate between the buyer and the seller, especially after the deal is done. So this form, if you read across it, is filed by both the buyer and the seller.
Yep.
And they both have to disclose to the other what their ID number is, what the name is, because they're both going to file this with their returns. And yes, IRS does test to see if the asset allocation is the same between the buyer and the seller. Could it be modified? Well, that's what the back is. You could have a supplemental agreement. But basically, IRS is looking at something called the residual method. It is starting with cash. Does cash ever change hands in a business sale? All the time. You have a liquor store with cash in the till. That's the base. That money is going to be transferred. It's going to stay in the till. We're not going to take it to the closing, but we're going to say there's $100 in each cash drawer, whatever the amount is, that's going to be transferred. Accounts receivable is a category. Marketable securities is a category. Number 4 is the property, plant, and equipment. So those are the hard assets that you can see and touch and feel, like these tables, etc. And then you get into 6 and 7. 6 and 7 is the soft touch that you can't see. That's the phone number. That's the non-compete. That's all of the stuff that kind of holds the business together that you can't set something on, right? So those assets and they are valued in a residual manner. We know what cash is. A dollar is a dollar is a dollar. We should be able to have an agreement about what receivables are. Anything shorter than 90 days, we're going to bring those in. Maybe that's 20,000 of the deal. The furniture and fixed assets are going to be valued, and we're going to agree. Now, for the seller, that may mean recapture of depreciation because they're selling for 100,000 and their book value is 0. What does it mean for the buyer? They could potentially expense 100,000 on their first tax return because of 179 provisions. What about that residual stuff that you can't see or touch? It's 15-year write-off for the buyer. And what is it for the seller? Well, it could be capital, but if it's a payment for non-compete, you're paying somebody not to do something, that's ordinary income. So how that's valued is going to come out to the seller as ordinary income, not subject to self-employment because we're paying you not to do something, right? And if there's a consulting services agreement, that's not even on this piece of paper. So you agree that you're going to sell 100 hours of your time as the seller as a consultant, and you're going to price that. $50 an hour, $100 an hour, whatever it is, over a period of 6 months or however the arrangement is, that's going to be earned income to the seller.
Absolutely.
Right, so you can have all kinds of different characters going on this form and outside of this form at the closing.
Absolutely.
Right.
And so what I make sure and do is we have a term in the asset purchase or in the purchase agreement where the allocation is agreed upon by both parties ahead of the closing, so that there's no ambiguity. Tell you
how many times in my career we get the asset purchase agreement from our buyer who comes in and says, well, I've got this corporation set up, we're ready to go, and it's filing period. It's March 12th, right, and the return is due in 3 days. Go to the asset allocation schedule, and it's blank. It's referred to as attachment
an exhibit
A.
that isn't there.
Exhibit A.
Yeah.
Oh, it's there. There's a title there, but it's totally blank. Well, they told me you'd figure that out. They say to me, okay, with the other accountant, with the seller who's gone to Nicaragua, who am I supposed to figure it out with?
Right.
Yeah, that kind of thing. So this is really critical because it is filed by both parties.
Absolutely.
Okay.
Absolutely. And there may be a settlement statement involved if you have a good CPA firm involved. Some attorneys are real sticklers for this. I've seen it go both ways where there isn't necessarily a settlement statement, but the settlement statement usually looks a lot like a settlement statement that you would get for purchasing a home. So it's what the buyer brings to the table and has to pay, what the seller brings and has to pay, and then the lines on the bottom of what they have to show up with or a check they get at closing.
And there aren't 1099s floating around here unless it's a registered corporation where you're going to have a broker deal.
Right.
It's not even a title company that's going to cut a 1099.
Right.
It's really based upon the 8594
Absolutely.
And how that's reported.
Absolutely. Right. So the transition post-closing. So a lot of people sort of in this process, they work, and get to the closing table, sign all the documents. I'm done, right? This is when the real work starts, right?
Now you bought something.
Right.
You're on the hook for this. You need to make this work, right?
So if certain things don't happen at closing, from a legal standpoint, you're going to want to make sure that in the transition post-closing, they actually do take place.
Right.
So it's turning over titles, deeds, keys to the building, those sorts of things.
Computer codes, passwords.
Computer codes, yeah, exactly. Exactly.
Good,
License numbers for software,
boy,
all of those sorts of things. And then in an asset purchase, the employee transition actually is fairly interesting because right prior to closing, the seller is going to terminate all of the employees, and then right after closing, the purchaser is going to decide if they want to hire those employees back.
Right.
And so that's kind of a cumbersome transition.
All new documents,
exactly.
W-4s, I-9s,
Exactly.
everything.
Yep. And not, like Fran said, not all employees may be coming along for the ride. So you're going to want to take that into consideration as well. A lot of times too is there has to be a new business entity. So there are times when I advise my clients, if you're doing an asset purchase, You're transferring new assets into an existing business. You may want to set up a new business entity to house those assets from a liability standpoint. The activities of your existing business may generate some liability over here, and you may not want the assets of your new purchase to be accessible to any creditor or claimant in a legal judgment.
And here we've got single-member LLCs, so there's a way to kind of transparently do that, but
Exactly.
you still have new payroll, you still
Yep.
have, right, so there are ways to protect with liability without making it totally cumbersome in the
Right,
process.
right. And then how do you assume any contracts that are involved? So post-closing, you may have to go to vendors, clients, raw material suppliers, and say, hey, there's a term in here that says a purchaser can assume this contract. Let's go ahead and get that done from a legal standpoint and get it documented so that those agreements are in place.
And then if you're the wedding cake baker and Sally walks in July and says, well, I'm here to pick up my wedding cake that I contracted for a
Right.
year ago, and her name wasn't on any list that you ever saw, those become kind of issues that are subsequent to the deal as well.
Absolutely,
Right.
absolutely. So just some kind of closing considerations, general considerations in these types of transactions. The CPA or valuation specialist on the front end, I can't stress how important that is. Again, I go back to the one story I told earlier. I usually save that story for this particular slide. But a minor investment on the front end in a good CPA valuation specialist can pay huge over the life of the transaction. And then from an attorney standpoint, obviously in larger transactions, it may be beneficial to go with really big law firms who have significant M&A assets in-house. So they may have an ERISA lawyer, they may have a patent attorney on staff. But even if you go with small firms or private practitioners, make sure that that person has an effective network so that they have access to these specialty.
And they've done it before.
Yeah.
That's another thing. You don't want to pay for their learning curve.
Right.
No offense, I don't think
Yep.
Heath has got one in this
Right,
transaction.
right.
but,
Yep,
yeah.
no question. From a broker agency or a broker standpoint, I'll just touch on this really quickly.
Okay.
So I've been involved in transactions where there's a broker, and I've had it go really well, and I've had it go not so well. So one of the considerations that you're going to want to look at is what is the agency arrangement with this broker. So they can be a buyer's agent, they can be a seller's agent, or they can be a transaction broker. If they're a transaction broker, there's no legal or fiduciary duties to either the buyer or the seller. Their only duty is to be honest with both parties. So I've seen a lot of brokers prefer this type of transaction because they're essentially off the hook, right? There's no fiduciary duty for them to treat any one party any differently. It's basically just don't lie to anybody and you're in the clear. From a seller standpoint, a broker can be extremely valuable in that they can work really hard to go out and find a buyer for your business.
Do the marketing.
Exactly.
All of that.
Yep. In those types of arrangements, I like to see them be a buyer's agent. Let's be honest and have it, out on the table so that if a seller's agent.
Seller's agent. Yep.
Let's have that on the table so that if the seller does come, that the broker is actually being transparent about who they're negotiating for. I actually had a recent transaction where I was representing a potential buyer. They had located a potential business to purchase through a broker who had it listed, and the broker was pushing my client to sign the asset purchase agreement and put a huge down payment or earnest money down before the key terms had even been negotiated. And so, that's the bad side of the broker arrangement. And long
it
story
can
short
be,
is I told my client to walk away because they weren't getting the information they needed from the seller as far as the being transparent about the financials, the customer lists, those sorts of things that we showed on the preliminary due diligence. And on the backside, you had a broker that was pushing them. Just pay the money and sign the agreement and we'll get the terms worked out later.
And we'll work it out later.
Yeah, exactly.
No.
Exactly.
No. Buying a business is a lot like getting married. I mean, you're making a huge commitment financially, emotionally, and if you make a bad buy, it isn't just put it back on the market and try to resell it. It is not like a house. It's not like a car. There are a lot of moving parts, especially if there are employees involved. They're vested in this. You're impacting lots of people's lives in both the buy and the sell of a business. And that's why it can be emotional. The broker, if they're a good broker, and there are good brokers out there,
absolutely.
will put a seller through their paces and won't instantly list at what the seller wants to sell for. They do due diligence on their part, and they look at the financials, and they come up with a plan, and sometimes they'll say, it's not time. This isn't a realistic price. You can't ascertain that. But it won't stop the seller from going to the internet and going on buysell.com or whatever. That's
And
their
some
problem.
brokers actually have valuation specialists in-house
They do.
to help them with that process up front.
And if it's a broker that you have a pizza parlor and that's all they sell are pizza parlors, that's your go-to guy. They're going to know how to price it, but they're
Yep.
also going to ask a lot of questions because they know the business really well too. So those are good brokers, the ones that want to list, and what do you think it's worth? What do you need? $1 million? Okay, I'll get it sold for you. They're the ones that are going to be, well, you just need to sign the document here. Give us a big
Exactly.
down payment, because they're commission driven, and
Right.
that's all.
Exactly.
And they'll walk away from the deal. You signed all kinds of non-disclosure
Yep.
agreements, and it was in the 5.5 font that was in there someplace that they had no liability or responsibility. So,
Absolutely.
yeah.
And the only other thing I'll say about a broker is if the broker wants to use their asset or stock purchase agreement and they're really adamant about doing that, I'd be really wary of
Yeah,
that. Usually the attorneys from either side, either the buyer or the seller, are the ones who are going to draft those agreements.
It's a standard contract. I love that.
Yeah.
Yeah, no, every business is unique, and it should
Exactly
have a
right.
customized document.
Exactly right.
Okay.
So from the negotiation standpoint, understand this is a very psychological interaction between the buyer and the seller. I like to see preliminary direct negotiation between the buyer and seller on the front end to kind of work out the key terms, because I can tell you if they work out the key terms face-to-face with each other, there's a lot less billable hours on the end during the transaction from their attorneys to have these same negotiations. And it's sort of like on the internet, we say things we wouldn't necessarily say to somebody's face. Exactly the same way in the negotiations. Either parties, the buyer or the seller, will say to their attorney, well, go tell them this, when they definitely wouldn't say that to the person's face. So I like to see upfront negotiations. Doesn't always happen. Doesn't necessarily mean that the deal's going to go sideways. But if you can get those negotiations up front and then do the final negotiations with counsel, there's a lot less billable hours and it usually goes a lot smoother.
It'd be nice too if they liked each other.
Absolutely.
Because I had a client years ago sold in his late 60s to a young guy, MBA, and it was a machine repair shop, believe it or not, here in Denver. They were at loggerheads all during the negotiation. The deal should have never happened. They were black and white. I mean, they were just totally different from each other, and their philosophies were, and they sued and countersued, and I got pulled in because they were in arbitration on a lot of the issues 3 years after the sale had occurred. Well, you promised me, you said this. Oh, it just became the Hatfields and the McCoys over this whole thing. So it really is nice. If you're going to buy somebody's business, they've got a lot of ego in it.
Right.
You're going to have a lot of ego in it. It's really a good idea. And if you don't like each other, that might be a signal to,
Right.
let's not do this.
Right. And in the corporate context, maybe they're very large corporations that are either buying or selling.
Different cultures.
Get the upper management involved as
Yeah.
well so that
Yeah.
they can talk face to face and kind of establish these relationships. And then the other thing that I tell people is beware, and I alluded to this earlier, beware of the letter of intent. So what happens is, even though that letter of intent may not be legally binding, the parties get emotionally invested in that letter of intent. So if anywhere in these negotiations the other party says, hey, you know what, I want to change this term, the other party's going to go, well, wait a minute, we already agreed to that. It's in the letter of intent.
That was in the
So
very-
they're,
right.
they're sometimes a lot harder than you would think to deviate from,
Right.
even though they're not a legally binding document.
Yep, price is going to be remembered regardless, and the date of closing is going to be remembered, even though there are all these conditions subsequent
Right,
that are built
right.
into the deal.
From a legal standpoint, and I'll hurry through this, I know we're running out of time. The purchase agreement should have certain contingencies. From a purchaser standpoint, I like to see those just in case things go sideways. Maybe there's a bad actor clause. If there's any criminality that you find in your due diligence, you can get out of it. Financing, if your financing doesn't come through, very similar to a home purchase. I always like to put on the documents as they're going back and forth. These are continually subject to ongoing due diligence. So until closing, until the final draft is there and the parties sign, there's always room for negotiation.
And indemnification too,
Yep.
and the purchase price allocation,
Exactly.
which we covered pretty much at length.
So final conclusions, engage your team early and often, could save you money in the long run. Take your time in the early due diligence and analysis phases. So if there's red flags that pop up, don't be afraid to walk away from the deal. Like
Right.
Fran said, some of the best deals may be the ones that you walk away from.
right.
And then maintain a positive working relationship with all parties involved. It makes it really, really hard if the purchaser and or the seller don't like each other, or any of their team members. Maybe
Right.
you have attorneys that don't get along, or CPAs that don't get along, or
Right.
brokers that are causing issues. Try to maintain a positive working relationship throughout the entire transaction. Makes things go a lot smoother, and it costs a lot less.
Yep. Questions?
So that's it.
Anything in particular, or are we out of time? We're still okay?
Yeah.
Okay, good. Yes?
As far as evaluating a price, would it be 3-4 times EBITDA? I've seen anywhere from 2 to 7 times EBITDA. So what's 3 or 4%? 3 or 4 times, I'm sorry, is normal?
Depends upon the business. It could be a multiple of gross, it could be a multiple of EBITDA. It totally depends. I
And-
charge a lot of money to figure that out. Are you kidding? I do have a book, the Business Reference Guide, that has rules of thumb for certain industries. The pizza parlors, there are lots of transactions for pizza parlors. There are lots of transactions for Subway stores. So if you've got something like that that's fairly, I walk into one Subway or another Subway and I get the same sandwich and they make it in the same ovens, I can predict based upon a multiple of gross or EBITDA that's what the sales price is going to be. Plus or minus, is the equipment new? There's always variables. What's the location like? What's the foot traffic? Is King Soopers going to shut their store down? So even with a pizza parlor or a Subway store that's got more of a predictable multiplier, stuff goes on in the world that they can't control or contain. Does that make sense? So there really isn't a one-size-fits-all multiple. Karen?
Change the business structure, like if it was set up as a LLC or a DBA or an S corp or whatever, do you ever change that when you buy it?
So the question is, do you change the business entity structure? Are you talking pre-closing, post-closing, either or?
Yeah, like, is there?
Yeah. So I've seen transactions where a purchaser comes in, they want to buy the business, and I'll give you an example. We had an LLC that was the selling business entity. They were being taxed as an S corp. An LLC was the purchasing entity.
Okay.
An LLC cannot be a shareholder in an S corp.
corporation.
So we had to change the taxation for the selling LLC to be taxed as a partnership prior to that transaction taking place. Even post-closing, there are aspects to that as well. And from a taxation standpoint, Fran and her team can help you out with that. But you'll want to take into account self-employment tax issues, right? Very
With the
different from a
flow-throughs.
partnership versus an
Right.
S corp. And so you may want to change that entity structure post-closing as well.
The entity doesn't matter if you're not buying the stock.
Right.
Because the buyer's going to create
Right,
their own
exactly.
entity. But if you're buying the ownership, then the entity may or may not be able to change. In what Heath just described, if they were being taxed as an S corporation, that would have required a liquidation.
Yep, exactly.
They had to liquidate
Exactly.
the S corporation and restructure as an
Unfortunately, there
LLC.
weren't a
That's
whole lot of assets in
taxable
that
event.
acquisition yet.
That's a taxable event
absolutely it
before
is.
the sale.
Absolutely it is.
And so if they had been an LLC taxed as a partnership,
Yep,
and the new buyer wanted to be an S corporation, they could change that structure.
So that's a
by
great
the-
point. Yeah,
right.
the answer to the question is yes,
But
but there are implications, right? And
Right,
you need
there are.
taxation implications and legal implications that you need to take into
But-
consideration.
most deals are asset purchases.
Absolutely.
And then the buyer has already made a decision about, I'm going to, and we like the LLC
Right, I
simply
do too.
because predictably in the initial year, there may be some losses. And the partnership rules are much simpler to be able to claim the losses
Right.
than the S corporation.
Right.
Basis rules are different. So that goes to, but the LLC can almost immediately elect to be taxed as an S corporation or a C corporation. So I like the LLC for a startup, even if it's a pretty healthy startup, just because you've got a lot of options about
I
which
completely
direction
agree.
you want to go. Cool.
Yep,
I work with a tax attorney, and he uses what's called the M453 monetized installment sale to save money on capital gains taxes on the sale of a corporation or any appreciable asset. For example, we were working with a large machine shop out of Wisconsin. This guy Rex was selling his company for $24 million. He had a buyer lined up through a broker. And because of 39 years of depreciation, his tax rate was over 50%. And so this tax attorney came in and actually erased the recapture. I don't know how he did it, but it's very advanced tax law. That'd be something to consider on to save clients money on the capital gains.
I've had clients look at ESOPs, which is a mechanism, but I've been told by bankers that the ESOPs are not going to work if the sales price is not $5 million or more. So, because you've got a lot of costs with third parties, and that is a miracle of tax planning if you can get into an ESOP. It's especially good if you've got key employees that want to buy the business. The ESOP is really an incredible tax savings, or can be. So there are certainly mechanisms out there, but again, it goes to facts and circumstances. And generally, if you're going to sell to a third party, it's going to be a taxable event, and you're going to mitigate that maybe by an installment sale. There are some other options. Or maybe you're going to start another new business, and you're going to sink some of that into the other new business. So there's always planning opportunities. On
Yep.
the buyer's side, where are they getting the cash? A lot of times they're getting the cash out of their retirement account. And they need to count on maybe some losses coming out of the business to kind of offset that retirement draw. Or worst case, they're doing a ROBS, where they're financing the entire business purchase with their retirement funds.
Right.
I totally try to discourage that. I don't know if you've gotten involved with any of those or
I have not.
But there are lots of unique bells and whistles that can be used, but you don't know till you get there
Right.
when you're dealing with the seller. I had a client that sold for $6.8 million in 2008. And we had looked very hard at an ESOP, and KeyBank told him they were just a little bit too small to accomplish that. So I just want to caution you, you can have all kinds of bells and whistles, but you got to look at the cost too.
yeah. And I should have said this up front, the boring lawyer speak, but Fran's point is a good one. Each individual transaction is going to be very custom, so none of this should be taken as legal advice. And do go out and find individual counsel or
We're not responsible
CPAs.
for anything you do.
That's the
Wasn't
best
there a
legal
disclaimer?
disclaimer I've
There
ever
you
heard. Any other questions?
Sure.
All right. Well, thank you
All
very
right.
much again to
Thank
Fran
you.
and her team for setting this
And
up.
thank you, Heath, for doing
Bob and Ignite Productions for the video, and thank you all for coming.
You bet. Thank you.